Hello friends. In today's video, we will be discussing about CELH Holding Incorporated, ticker symbol CELH, which is a company growing rapidly in the fitness beverage industry. So we will take a look at the following by reviewing the information in the company's recent investor presentation. An overview of the company, their products, distribution model, the financial metrics, and then we will analyze if the stock is worth investing in, and if so, at what price we should be buying. Let's get started. So CELH was founded in 2004, and the company develops, markets, distributes, and sells functional calorie-burning fitness beverages in the United States and internationally. The company distributes its products through traditional retail and e-commerce channels. The company is hoping to become a global leader in the fitness, food, and beverage industry by building a brand with a portfolio of products that are clinically proven to offer significant health benefits. Now let's look at their products. Their core product, CELH, is clinically proven to accelerate metabolism and burn body fat when exercising. As you can see here, it comes in 11 different flavors with no added sugar, is gluten-free, and also vegan, which would certainly help them to cover a very broad market. The next product is CELH Heat, which is a pre-workout beverage designed to optimize performance and provide an energy boost. This again is available in many flavors. Then we have the CELH BCAA, which is a post-workout recovery drink, and there are 3 different flavor options. Up next is CELH Stevia, which is sweetened using stevia, but otherwise is pretty similar to the core CELH beverage. This comes in 4 flavors. And finally, there is the CELH On The Go, which is a powder stick packet designed for traveling customers, as it is compact to carry and just needs to be mixed with water when they want to enjoy the drink. In addition, CELH also acquired Funk Food Group in 2019 to expand their European operations. As part of the deal, the sports nutrition brands Fast, Coco-V, and FitFarm got added to their product portfolio. CELH is also expanding its operations worldwide, so far most notably in China, Malaysia, Sweden, and Hong Kong. Overall, I like the company's product diversification and messaging, but I was a bit suspicious about the company's health benefit claims. So I did some further reading and found that their claims are backed by 6 university clinical studies, which should give us some confidence in the science behind the company's products. It is also promising that the National Advertising Division of the Council of Better Business Bureaus has examined and endorsed these university studies. I will put a link to these studies in the description below in case you are interested in reviewing this in a little more detail. In addition, I also found that the company had successfully defended a lawsuit in 2011 where a California judge ruled in favor of the company in a class action lawsuit filed alleging false and misleading advertising. I will also put the link to this news article in the description section in case you are interested to read further. So overall, I think there is reasonable evidence out there for us to have some trust in the company's products and the health benefit claims. As for the distribution model, they target both the traditional retail route as well as e-commerce. In retail too, there is coverage across different subcategories such as natural food stores, convenience stores, grocery chains, fitness clubs, supermarket chains, wellness stores, military, and vending machines and caterers. I'm not going to read out the names of the stores they have partnered with, but as you can see, most of the popular names have been listed here. The e-commerce distribution is mainly via Amazon, Walmart, and bodybuilding.com. I also quickly looked up the reviews on Amazon, and for the most part, the products have very good reviews. Let's now move on to the financials of the company. As you can see here, the revenues have been growing at an exponential rate, compounding at 45% annually. Especially if you notice, the 6-month revenue in 2020 of $58 million is already pretty close to the 2019 full-year revenue of $75 million, which is quite remarkable in spite of the recent economic challenges that the world has been experiencing. Even internationally, the revenue growth in 2020 has been stellar, and this trend could be expected to continue for at least a few more years to come as the company expands its international operations further. And as you can see here, their gross profit margins are also very good at 45% or 52%, depending upon whether outbound freight costs are considered as part of the cost of sales or not. Such high margins would only make the company's position stronger as their revenues continue to expand in future. You can also see in the chart towards the right that the gross profit margin has been pretty steady over the recent years as well. In terms of net income, the company is barely profitable currently, but this is typical of companies in their growth phase where the focus is more on capturing market share rather than accumulating profits. Now let's review their financial health by looking at some key metrics from the balance sheet. As you can see here, their total current liabilities as of Q2 2020 stands at $30 million compared to total current assets of $61.9 million. This gives the company a current ratio of 2.1, which is a very healthy number. Even better, they don't have any significant long-term liabilities, so the company's current financial position can be considered to be very strong. Okay, so then what are we waiting for now? With all the things we have looked at so far, CELH Holdings looks like a very good company overall. So should we just invest all our available cash into the stock? I wish it is that easy, but this is where valuation comes into the picture. So let's now look at the current valuation of the company and try to assess if it is still a buy at the current price by simulating a couple of future scenarios. As you can see here, the stock price at the time of recording this video is $20.72. There are approximately 71.5 million shares outstanding as of Q2 2020, so that gives the company a market capitalization of around $1.48 billion. So if we look to value the company based on their trailing 12-month earnings per share of 3 cents, that gives us an insane PE ratio of 690, which is extremely high. But since this is a growth company, it is okay to ignore the PE ratio for now. We could use the price to sales ratio instead, as it is a better metric to assess growth companies, especially the food and beverage industry. So if we take the current stock price and divide by the trailing 12-month revenue per share, we get a price to sales multiple of 13.9. Compared to the company's historical metrics, this would mean that the stock is a bit overvalued at this time. Even though it is a growth stock, it is better to buy when the price to sales multiple is 10 or lower, but as long as you believe in the company's future growth potential, it is also okay to start investing now using dollar cost averaging. So we could say allocate 5% of our total portfolio to invest in this company and further break it down to keep buying in chunks of 25% if and when the stock price trends down. So as you can see, instead of say investing $4,000 at the current price of $20.72 to buy 193 shares, we could buy 228 shares instead by investing in smaller portions at every 10% price drop. So in the end, we will end up investing the same $4,000 to buy 228 shares at an average price of $17.54. Of course, this would work only if the price drops, but with growth stocks, usually there are always price swings, so we would most likely get better entry points if we are patient. Having looked at all this information, let's also now see what returns can we expect to see in say 2025 if we decide to buy the stock today. For this, let us try and project the revenues and earnings and assign various price earnings multiples to simulate the returns we could expect. So as you can see here, analysts expect the 2020 full year revenue to be around $125 million, followed by $164 million in 2021. And as we saw earlier, the company has been growing revenues at the average rate of 45% annually, so I think it is reasonable to expect a 30% growth rate until 2025 at least. But to be conservative, let's say the growth rate is 25%. As you can see here, that would get us to around $400 million in revenue in 2025. Now that we have the revenue estimate, to further assess what returns we can expect, let's now simulate what the stock price would be at various PE multiples. So based on the $400 million revenue estimated in 2025, in terms of earnings, we could then reasonably assume that it would be around 24% of the revenues, as similar but a bit more mature player like Monster Beverage currently operate with a 27% net margin. So that would give us an estimated 2025 earnings of around $96 million. And since the company has around 71.5 million shares outstanding, that would then give us an estimated earnings per share of $1.34. So with the numbers estimated so far, we can assess what the stock price will be at various price to earnings multiples. So as you can see here, if we go with the price to earnings multiple of 10, which I think is being extremely over-conservative, we would end up with a stock price of $13.40 in 2025. Similarly, a price to earnings ratio of 20 would take the stock price to $26.80, and so on. Personally, I think it is safe to work with the 20 price to earnings multiple, which would mean we'll get a gain of around $6 per share, which translates to a 29.3% profit over the 5-year period. This is okay, but not that great, as it would mean that we only get a compounded annual return of 5.3%. So I feel a better approach would be to buy the stock using dollar cost averaging, as I mentioned earlier, as we could then get an annual return of 8.8% instead if we can manage to buy the stock for an average price of $17.54 over time, instead of just buying the entire position at the current price. And obviously, we can also end up making much higher returns if the market values the company at a higher PE multiple in 2025 and beyond. So to summarize, I personally think that Celsius is a great company to invest in, but better to do this using dollar cost averaging. So patience is the key here, which is also basically the cornerstone of a long-term investing strategy. Hope this video gave you a good idea of Celsius Holdings and why I think it is a good stock to consider adding to your portfolio. And depending on your personal situation, you could also use options techniques like selling covered calls to further enhance your returns. So let me know in the comments if you are interested in learning more about this, and I would be happy to answer your questions. And as a friendly disclaimer, please note that I am not a licensed investment advisor, and my videos are only meant to document my views on various investment-related topics that I am interested in. So please consult with your own investment advisor before making any investment decisions. And if you enjoyed this video and got some value out of it, I would really appreciate if you can please leave a like below, share it with your friends, and subscribe to my channel. Have a great day, and I'll see you in the next video.